session bias is trending bearish across all 4 major timeframes. This is not a range. This is not a fade yet. This is a structural breakdown that started on the weekly chart 3 weeks ago and has now cascaded down to the 60-minute. Write this number down, 1.3450. If we see a daily close above 1.3450, the entire bearish structure resets and we reassess. Until then, every rally is a selling opportunity until proven otherwise. Here's what the herd is doing right now. Retail long positioning actually increased 8% after the Bose hawkish comments. They bought the story without watching the price reject the story. Institutions, meanwhile, have added to shorts for 4 consecutive sessions. The herd is leaning the wrong way into a trend that's accelerating. That's your edge. The single invalidation level that flips the bias is 1.3450 on a 4H close. Below that, gravity is your friend. Let's read the chart from the top down because that's the only way to avoid getting faked out by noise. Starting with the weekly time frame, the MA200 is sitting at 1.3386. Notice where price is. We are trading at 1.3341, which means we have already closed below the 200-week moving average. That is not a small event. That level held for 9 consecutive months. Now price is on the other side of it. The weekly MACD crossed negative 3 weeks ago and the histogram is expanding bearishly. Momentum is accelerating, not slowing. Moving to the daily chart, this is where the story gets really clear. MA20 at 1.3446, MA50 at 1.3466, MA200 at 1.3386. The moving averages are now stacked bearishly, MA20 below MA50, and both are sloping downward. The death cross formation is actively playing out. RSI at 38.5 sounds oversold until you realize that in a strong downtrend, RSI can hold between 30 and 40 for weeks. We are not at 30 yet. There is room to run. The daily MACD shows the histogram at negative 0.001, but more importantly, the MACD line is below the signal line and both are below 0. That's the definition of bearish momentum confirmation. Now drop to the 4H chart. This is your execution timeframe. MA20 at 1.3403, MA50 at 1.3420, MA100 at 1.3448. Price is trading below all of them. The 4H MACD just made a lower low after a tiny bullish cross attempt failed. That is a bearish re-entry signal. The failed convergence tells you buyers stepped in at 1.3379 support, got rejected, and now those same buyers are trapped and will become sellers on the next leg down. The 60-minute chart confirms the cascade, MA5 at 1.3403, MA10 at 1.3420, MA20 at 1.3446. Every single moving average is sloping lower. The 1H RSI bounced to 51, which in a downtrend is simply a retracement to sell into, not a reversal signal. Here's what most traders miss. Look at the relationship between the 4H MACD and price action from 3 days ago. Price made a higher low on Tuesday. The MACD made a lower low. That's hidden bearish divergence on the 4H. Most people only look for regular divergence. Hidden divergence tells you the trend is pausing to reload, not reversing. We are in a bear flag continuation pattern on the 4H with measured move down to 1.3260. Key support levels are 1.3402, then 1.3379, then 1.3348, and we are currently testing that third support as we speak. Key resistance levels are 1.3456, then 1.3487, then 1.3510. The first resistance is the line in the sand for any long attempt. I want you to notice something else. The 4H bear flag's pole length from 1.3510 down to 1.3348 is 162 pips. A measured move from the flag breakdown projects to 1.3186. That is your structural target if 1.3348 gives way completely. Fundamental driver and cross-linkage. 4:30 to 6:30 yesterday's US payrolls print changed the entire narrative. The market expected 185,000 new jobs. The actual number came in at 228,000. That is a 23% upside surprise. And the unemployment rate ticked down to 3.8% from 3.9%. Here's why that matters for pound sterling to US dollar specifically. The Bank of England has been signaling that they're done cutting. 2 MPC members voted for a hike at the last meeting. But the market's response to that hawkishness was muted because the dollar story is simply more powerful right now. US 2-year yields jumped 12 basis points after the jobs number. UK 2-year yields rose only 4 basis points. That yield differential, now at 112 basis points, is the widest it's been in 3 months. The pound cannot compete with that differential when risk appetite is stable. And that's the cross-asset linkage most people miss. The S&P 500 is up, VIX is down, credit spreads are tight. In that environment, the dollar doesn't need a crisis to rally. It just needs relatively better yields. And right now, US yields are winning. The narrative web connects directly. Stronger US labor market means later Fed cuts, which means wider differentials, which means lower pound sterling to US dollar. The only thing that breaks this chain is a collapse in US equities that forces a flight to safety dollar rally. Ironically, that would also push pound sterling to US dollar lower but for different reasons, or a massive dovish pivot from the Fed which is not on the table after this print. Do you think the pound finds support at 1.3300 this week? Comment yes or no right now. I'm tracking consensus and I'll read the most interesting takes in the next video. The 1 to 2 week directional lean remains bearish with a target of 1.3220. The exact event that invalidates this is a US CPI print below 2.8% core year-over-year. That's the number that would force the Fed back into play. Until then, sell rallies. Most people skip this section because they think they already know the trade. That's exactly where the money is made. Keep watching because I'm about to give you 3 distinct strategies with exact prices, not vague zones. Strategy 1, the sniper, conservative. This is for traders who wait for the highest confirmation and lowest risk entry. You are not trying to catch the entire move. You are trying to catch the highest probability 50 pips with a tight stop. The trigger condition is a retest of the broken support at 1.3402 that now becomes resistance. Wait for price to rally back to that level on the 1H or 4H chart. But do not enter immediately. You need confirmation. A 1H candle that closes below the high of the previous candle after touching 1.3402. That is your pin bar or inside bar breakdown, entry at 1.3395 after confirmation. Stop loss goes 4 pips above the recent 4H swing high at 1.3451. That gives you a stop at 1.3455. Total risk of 60 pips. Target 1 is 1.3330. That's 65 pips, just above your first risk-reward ratio of 1 to 1.08. Not great, but that's not the point of the sniper. Target 2 is 1.3260. That gives you 135 pips and a risk-reward of 1 to 2.25. What voids this setup entirely? A daily close above 1.3450. If that happens, the structure is no longer valid and you move to a different playbook to the sniper, conservative, entry. 1.3395, 1H close below retest of 1.3402, stop loss. 1.3455 take profit 1. 1.3330 take profit 2, 1.3260 risk, reward, 1:2.25R, to TP2, invalidation. Void if daily close above 1.3450. Strategy 2, the active trader, standard. This is for traders who want to participate in the trend without waiting for a perfect retest. You are selling bounces into the moving average cluster. Entry condition is a pullback to the 4HMA20 which is currently at 1.3403 and drifting lower. As of this recording, that level is rising into price. You want to see price approach that MA20 with a bearish rejection candle, a long upper wick on the 4H or a 1H bearish engulfing pattern, entry at 1.3405 on the rejection confirmation, stop loss goes above the 4HMA50 at 1.3430. But we need a buffer. Place the stop at 1.3445. That's 40 pips of risk. Why 1.3445? Because that's the level where the 4HMA100 sits, and if price breaks that, The bearish momentum is temporarily disrupted. Target 1 is 1.3345, that's 60 pips, giving you a 1 to 1.5 risk reward. Target 2 is 1.3280, that's 125 pips, giving you a 1 to 3.12 risk reward. Once target 1 is hit, you trail your stop to break even. Then let the second half ride. The trailing stop rule after target 1 is to move the stop to entry plus 5 pips. That guarantees profit even if the market reverses violently. Type your expected pound sterling to US dollar range for tomorrow in the comments right now. Let's see who's aligned with the technicals. The active trader, standard, entry, 1.3405, 4 HMA 20 rejection candle, stop loss, 1.3445 take profit 1, 1.3345 take profit 2, 1.3280 risk, reward, 1:3.12R, to TP2, trailing stop. Move to break-even plus 5 pips after TP1 hidden validation. Void if 4H close above 1.3450. Strategy 3. The aggressor, high risk. This is a countertrend or momentum chase entry depending on how price arrives at the level. Either way, this is only for traders who can lose small and manage risk aggressively. The setup is a break and retest of the 1.3348 support level. Notice that current price is already at 1.3341. We are below that level. So you are either waiting for a reclaim and then another breakdown, or you are chasing the momentum break with a tight stop trigger condition. Price breaks below 1.3330 on the 15-minute chart with a full candle body close below that level. Not a wick. A body, entry at 1.3325 on the break confirmation. Stop loss goes just above the broken level at 1.3355. That's 30 pips of risk. Very tight. Target 1 is 1.3280. That's 45 pips, a 1 to 1.5 risk reward. Target 2 is 1.3220. That's 105 pips, a 1 to 3.5 risk reward. Here is the explicit warning. This trade is chasing momentum into a potential liquidity grab. The market often breaks a key level, trigger stops, then reverses violently to hunt new breakout traders. If you take this trade, you must be at your screen to manage it. Do not set and forget. Only for those who can lose 30 pips without tilting and move on to the next opportunity. What invalidates this setup immediately? A 15-minute close back above 1.3350 after the break. That is a false breakout and you take the loss immediately. The aggressor, high risk, entry, 1.3325, 15-minute close below 1.3330, stop loss, 1.3355 take profit 1, 1.3280 take profit 2, 1.3220 risk, reward, 1:3.5R, to TP2, invalidation. Void if 15-minute close above 1.3350. Warning. Momentum chase requires active screen management. Never risk more than 1 to 2% of your account on any single trade. The sniper strategy and the active trader are both valid for 1.5% risk. The aggressor should be cut to 0.75 to 1% because the stop is tighter but the volatility is higher. No positions through high-impact news. And tomorrow we have US initial jobless claims and a Fed speaker. Stops are non-negotiable. This is how you survive to trade the next big move. Let me summarize the single most critical level for the next session, 1.3450 on the daily chart. That is the line between a structural bear market and a range. As long as price trades below that level, every rally is a gift to sellers. The key support to watch is 1.3348. If that breaks with force, the measured move takes us to 1.3186. Next focus is the US initial jobless claims print and the Fed speaker. If claims come in below 220,000, the dollar gets another bid. If they spike above 235,000, we could see a short squeeze back toward 1.3400. That squeeze would be your active trader entry. If you want the full breakdown on how the S&P 500's gamma levels are impacting dollar liquidity and why that matters for pound sterling to US dollar, that video is live now. Tap the end screen. Smash like if this gave you a clear plan you can actually trade tomorrow. Subscribe, hit the bell, and I'll see you in the next one.